Welcome, everybody, to another episode of Sound Money Matters Live. And today we're going to be discussing what the heck happened to the gold and silver markets on Friday. And without any further ado, I'm not even going to waste any time. We have Rob Kientz, one of the best analysts in the industry, that's going to be talking to us about what happened. Rob, hey, how you doing, man?
Hey, Daniel, thanks for having me back on.
Absolutely. Well, let's get right into it. You got the data, you got the information. Tell us what exactly happened on Friday.
Well, we were talking about all sorts of reasons why you would expect the market to sell off, just like a general sell-off. We talked about the new Fed nominee, Warsh, and his stance on it and why that may be negative for gold and silver prices and maybe hitting some circuit breakers on some trade that people had. But I mean, I think and those are legitimate reasons why you would see a general sell-off in gold. Also, you had options expiration on the 27th earlier that week, and it's perhaps some people were in the money on their options, and so they let their positions go. But honestly, I mean, if you look at the size of move, it's unprecedented. Hey, Annie, how are you doing? Thanks for joining. It was just unprecedented. I was just running some numbers, and on the 30th, there for gold, half of the yearly world's production of gold was sold in a day. It's about 118 million ounces. 117 to 118 million ounces, and the sell-off was over almost 51 million ounces in a single day. In silver, there are 819 million ounces produced every year physically from the mines, and the short paper was 317,238 contracts of 5,000 ounce silver. So sold short was 1.5 billion ounces of silver, which is almost twice annual production of silver. Yeah, we don't have the COT report, so we don't know who did it. The COT report only goes to the 27th options expiration day. They did not include the 30th in there. We probably won't get that till this coming Friday. But it appeared, and then we'll know who did it. But I do know this, leading up to Friday, everybody that held open shorts, or the majority of people that held open shorts in gold and silver, especially silver, were foreign banks, according to the bank participation report put out by the CFTC. So if anybody was doing this, it was foreign banks, maybe through you could use American banks to do, the rules are squirrely. You could do it a bunch of different ways to where you're never going to know the actual person or entities doing it. But more than likely, since they held all the shorts, it was the foreign banks doing it because they probably needed to clear their shorts. If we look at what happened to silver in the last year to year and a half, it'd gone up by a factor of almost 6. It went from about $21, $22, $23 to $121. And essentially, it had gone up so fast that probably somewhere along the way, somebody lost a ton of money on their futures positions. You can only hold those shorts for so long. And when you short something, whether it be a stock or a commodity, your potential loss could be astronomical because there's no upside to what the price could run, especially in a mania. And for all intents and purposes, I mean, we had seen a mania breakout in gold and silver like I'd never seen, on a 50-year chart. So I had been saying probably 2 to 3 weeks in a row, maybe a month in a row, that I thought that there was going to be a correction, because whenever any market runs that hot, and if you look at the technical indicators, you'll hear terms like overbought in gold and silver, which means on a technical basis, it had risen so much without any sort of pullback for so long, it was unnatural that you would typically see in that kind of market. And just a reminder for people who may not be familiar with how the spot prices are determined, it's done in a combination of the London trade in the OTC market and in the US on the COMEX and the futures market. And those spot prices are determined on those paper trades. And as the numbers I illustrated just a minute ago, we're talking about, for gold, half a year of total mine production in one day. And then obviously silver, almost twice as much of yearly production in silver, about 1.7, 1.8x. So obviously it had nothing to do with physical. It's a paper trade. And dumping that much at once is designed to crash the prices hard enough to come down to be able to liquidate short positions and not lose billions upon billions upon billions of dollars. Now, as to who did it, we don't know. And the reason we don't know is if you look at all the available information from the CME group, which is oversees the market trading, and then you look at the CFTC, the Commodity Futures Trading Commission, which is the government regulator, And those types of reports, they don't tell you specifically who's doing what. They will tell you, they'll group it into groups and categories. So you'll have your producer merchants or the legitimate hedgers because they actually use or produce the metal. Everybody else, the bullion banks can take positions for anybody, but typically there's enough hedge coverage and producer merchants that they're not really doing it for a ton of companies that are worried about the price. Most of that speculative position, the financial houses are just taking it for price and they're putting it into their funds. So if you have a fund that invests in gold or silver, that's the managed money category. And then the other reportables are wealthy family offices, wealthy individuals, cooperatives, things like that. Most of that's not hedging. And most of the futures market, whether it being gold and silver, precious metals, sugar, oil, whatever it is, agricultural products, a lot of it's not hedging. A lot of it is speculative positioning, right? It's speculation on what the price is going to be. It's the futures market really turned into a gambling market, the majority of the trade. And I used this example when I did my masterclass on my channel. On any given day, typically in gold or silver, you'll see about 0.5% of that day's trade actually delivered in a physical sense, meaning somebody took delivery of that physical product. They took ownership of it in the COMEX approved warehouses. Not that they're even taking it off the market. They just have ownership and they're leaving it there. That's about 0.5% on any given day on average. Okay, so when you see someone come in and affect the trade with 2x global production like they did in silver in a single day, it's not the physical moving around. It's not really the physical trade. And indeed, we'll get the physical reports about what's available on the exchange. But essentially, this was a paper trade. We don't know exactly who did it because the foreign banks were the ones that own the majority of the shorts in gold and silver especially. You have to point to foreign banks and their customers as more than likely the ones that affected this because they had the most to lose by having just by having too many shorts. Because if those shorts keep running the upside, your potential losses they could go infinite. What if silver went to $200 and $300 and $400? You have to cover the difference between where you took the price, where you took that short, and the actual price on the day of. I'm looking at the available stocks on the NYMEX metals delivery report for silver, for example. There are 103 million ounces in the registered category, total eligible 300, so 408 million ounces, 103 available for trade. That's down from about 119 a few weeks ago. So there isn't as much liquid silver available for trade, but it's still sitting on the COMEX. So it's not as if it's been taken off. So again, all the things I just said, they're not pulling the physical silver out of the warehouses yet or the gold. It's just changing ownership within the depository in a delivery scenario, which is a paper delivery, just delivering, a warehouse receipt or a tag that says it went from person A to person B. So they didn't take it off just yet. So it's just paper positioning. And given the massive amount of shorts by those big global 4 and 8 banks, that's basically, it was short covering. And I even suspect that if you look at social media, there's been a lot of false information on social media in the last month in particular. We had AI guy, we call him AI Asian guy, that's been spewing out a lot of information which has not been verifiable, that typically would be verifiable. Things like the CFTC is holding special sessions that has to be reported. We didn't see it. Things like the silver market is going to collapse, the day before Christmas or the day before New Year's. All this stuff that's not happening, but what it does is it creates a fervor. And I've also noticed, Daniel, that there have been a lot of social media accounts, especially on Twitter, some on YouTube, some on some other channels like TikTok, there aren't a person. Like I'm Rob Kientz. You can validate who I am. You know who I am. You and I are friends. We served on the board of C4SM together. I have a face, I have a name, and I come on and I analyze the markets. There have been a ton of these accounts added to Twitter, TikTok, those types of places. Even I've seen it on Facebook where you don't know who the person is. There's not a face, there's not a name, it's a catchy title. And they have these sensationalist type headlines and things designed to get the market believing this fervor, and then the price bids up and the price bids up. And you would say, well, Rob, if a bunch of retail investors get excited about social media, how is that going to move the price in a derivative market? Because the traders look at that. The traders are betting on future price. if there is these sensationalistic articles coming out across social media that eventually get covered in the financial press that cover gold and silver, because they were, then all of a sudden everybody's getting this information. And what you have is a collective version of social engineering of a market to get people to the upside. And the prime examples of that, and a movie was made about this, it came out, I believe, in summer of last year. Correct me if I'm wrong, was AMC and GameStop. They were meme stocks.
Mm-hmm.
They got bid up. They didn't have the value in the corporation to hold those stock values or anywhere near it. And they got bid up, and it started on Reddit. It started on social media, and then it caught fire and people started investing in it. And things like Dogecoin, which in the crypto world, when Dogecoin came out, the founder said, this is a meme coin. This is a complete joke, but look at the valuations Doge got to at its peak. And there's no way that there was value in that coin, according to the founders. It was eye of the beholder. You can go back to Tulip Mania back in the day, where people bid tulips up because apparently they, everybody had to have one and there were going to be a big limit. And, obviously tulips don't live forever. So this is the modern day version of Tulip Mania in gold and silver. And I suspect that the people behind those accounts and the AI guy and those AI accounts and the social media push, it was almost coordinated within the last month. And a lot of these accounts did not exist prior to the last month, or they were very small.
Mm-hmm.
So there was a lot of momentum built up in those accounts, building this momentum that gold and silver running. In the silver side, it says silver is going to collapse, COMEX is going to shut down, which it can't because it has cash settlement and liquidation. So it was a lot of false information. And I suspect that the people behind that were trying to wash the price up, maybe to hit an options value. Options expired on January 27th. They took their money and they waited until a less liquid day on a Friday. And the market just got absolutely hammered with short paper. And again, for people who weren't here at the beginning, just joining, 1.5 billion ounces on Friday of silver sold short in the market. And as I'm looking at the CME Group's website on silver, 317,000 contracts of 5,000 ounce silver crashed the price $35 in a day on silver, $35 when it was about 121, somewhere in that range. And on gold on that same day, on Friday, January 30th of January, 508,000 contracts closed. 508,000. Okay, that's half of yearly production, give or take. And the change was $600 in a day. Never in my career covering this over 17 years now, I've ever seen anything remotely like that. Not only in the precious metals, any other commodity, including oil. Okay, and oil is a hotly traded commodity on the futures market. Never seen it in Forex. Never seen it in a stock in a single day. I mean, you would have to go back to things like Black Friday or the Great Depression to see those types of moves in the stock market. Never have seen that in the metals before. So I suspect that there was a lot of washing the trades out, hitting an options target. It expired on the 27th, and then flipping the script and saying, taking a lot of that money, buying some futures positions and crashing it down to cover, existing futures positions and reset the board. And there is a quote on an article from Morningstar from Luigi De Bellis, head of research at Equita, who says this is a liquidity event with volatility spiking. Sales were amplified by risk limits, margin calls, and volatility control strategies. Silver, being thinner and more speculative, magnified the stress as positions have become especially crowded. So here's the key about a leverage market like futures or Forex or these types of things that trade on leverage. For a very small amount of money, you can control a very large position. And if you can trigger somebody else's stop loss, or if you can trigger where they don't want to be in the trade anymore, it magnifies it. It's called waterfall effect, where all those other sell targets get hit, and then they sell and they sell. And in the U.S. stock market, there are circuit breakers to prevent a single stock, for example, collapsing too much in a day, because the algorithms trade this. And when they see the price going down, the algorithm could say sell, sell, sell. Well, the same thing occurs in the CME Group. And here's where the confusion really starts. And I've been researching this and haven't found the right answer just yet, but I'm going to keep researching. There are circuit breakers to the downside on silver and gold in the CME Group, but because a single trader or entity, or within a single period of time, as I understand it, did not trigger that, it was allowed to, so it went all day long. So it wasn't just a single set of orders. whoever was doing it knew the circuit breaker limits and were working within the circuit breaker limits. Now, this is very interesting to think about. If you're triggering other person's margin calls, how would you ensure that your sell order that you put in did not trigger enough other sell orders so that you didn't trip that downside circuit breaker? And what that means is the people that did this had information about the market. It's the only way. Because the CME group's already come out and said this didn't trip our breakers the way that I saw it quoted in financial media. I wish I had that pulled up. I'm sorry, I do not. It's my fault. I just didn't have time to pull it up, but I saw that quoted over the weekend. So somebody would have had to have known how to do this all day long and put all of those order ins as to not trip those circuit breakers in the specific rules. Now, who would know that? Maybe some of the market making banks. If you look at the short positions in gold and silver, and we know this from the Office of the Comptroller of the Currency of the Report and the CFTC COT report, if you put them together and look, it is very explicit that in all derivatives, and specifically in precious metals derivatives, including forwards and options and futures, that globally 4 banks hold the vast majority of those. In fact, I'm looking at the CFTC COT report for January 27, 2026, the latest available for silver, and the top 4 traders are short 25.7% of all short positions, and the top 8 traders almost half. So there are concentrated shorts in gold and silver, more so than any other single commodity on the futures market. And it's been that way for years. And so because these banks hold these short positions for their own account and for all of their clients, they happen to have the information knowing where their stops are and knowing where their limits are on the trade. So if you're trying to coordinate the market coming down, maybe you want to cover shorts, really the only people that can do that are the people that have the market information. And this is very famous. I used to work for a Forex broker back in 2009. It was FXCM. And FXCM, and I only worked there for about 9 months. I was trying to learn Forex. I got my Series 3. And within Forex, or money, currencies, it was a commodities broker's license. So I learned commodities and currencies. Okay. And I used to help, traders and support them and do that kind of stuff after I got my Series 3. And essentially what the way that FXCM said that they did is said, we're one of the Forex brokers that doesn't trade against our book, meaning they know electronically what all of their traders stop losses are and limit orders and stuff like that, because you put it in on the platform. It was later that in the US, there was a conviction around FXCM not telling the full truth. And I don't want to disparage FXCM. It's not the point of this, but if you look up the history of FXCM, whom I worked for, and I left about a year before this happened, because I looked at that and I said, there's some, I wasn't comfortable with that company. And I went back, to my audit and consulting career. I was only there for about 9 months. But in 9 months, I learned how all that stuff worked. But then afterwards, when FXCM collapsed and there were the scandal, they had apparently been trading against their book. Because why wouldn't you? If you're sitting on top of customer information representing a certain percentage of trades, and using statistical analysis, which I went through as an auditor, that if you have anywhere from between 10 and 25% of the available market information, as you go from 10 to 25%, depending on the type of information you're looking at, statistically, what the rest of the market looks like. Okay, because I use this all the time when we would do our sampling for audits and for data analysis. And when I got my master's in forensics, master's in cyber with a concentration in forensics, they taught us these principles as well. How do you sample out a population? And there was even calculus. When I was in my bachelor's, I had 2 calculus classes where we did this as well. So a lot of math in my history, a lot of experience, and a lot of training, collegiate training and corporate training around using statistics and how you can look at populations. Well, if you have market makers controlling a market like a Forex market, the example I just gave with FXCM, or if you look at a futures market and you have these big 4 or 8 banks trading, and again, on the Office of the Comptroller of the Currency report, the top 4 and 8 banks, especially the top 4, control the majority of positions in all derivatives, not just precious metals. We're talking bonds, stocks, Forex, and we're talking options, futures, forwards, the whole 9 yards. So these banks know this information. And I'm not saying that the bank colluded to do anything wrong. There probably needs to be an investigation. But I'm saying if you wanted to coordinate the market going down without tripping a circuit breaker designed to stop such a free fall, the only way to do it would be to stair step down the introduction of those trades onto the trading platform in such a way as to not trigger those. And so right now, analysts are asking the CFTC, they're saying, wait a minute, can you go back and look at this? This is almost impossible. That's why the circuit breakers are there. That's why they're there in the stock market. And maybe the circuit breaker is not designed effectively, but to have the worst down day in gold and silver since I've seen the day, like ever, really, because it wasn't until 71 when Nixon took us off the gold standard. It wasn't until 74 when we got the Commodity Act, or I think 74, and then got the trading. So I think in history, this is the worst down day in gold and silver ever in terms of the price movement on this new system, 1974 to now, that 52-year period of time where this is how we trade the markets. And, to not have that, to see that and to have circuit breakers in place and not have them tripped and to not be suspicious and to say, oh, this can completely happen. Well, first, it would be a complete failure by the regulator and the CME group in setting those circuit breakers, first of all. And second of all, like if you run those markets, how could you be inept? And second of all, if you're trading on those markets, the only people that would know would be the bullion banks who have all the data and people that have access to that trading platform. Could be other maybe large players, really large players that hold big positions. There's a lot of fishiness to this. Now, going back to what we were talking about before the program, there's some cover. There's options expiration on the 27th. You had a massive run up. It was overbought technically. You may have a new, Fed president. There were cover stories there, but not for that big of a fall in silver in a single day and that big of a fall in gold, especially when you're looking at the trades that were put in short. Again, almost 2x yearly silver production and almost half of all gold production were put in a single day. And one other interesting thing is China's Shenzhen Stock Exchange suspended trading in the UBS SDIC Silver's Futures Fund for the entire session. The halt was a regulatory measure to curb excessive speculation and a high premium, reaching from 36 to 64% over basically spot prices relative to underlying silver futures. So in other words, China, who doesn't run the global markets, but is a participant, but doesn't set price like COMEX and LBMA do, their circuit breaker worked for their silver futures fund when the people that run these markets that price world and gold and silver didn't. I'm sorry, but that's suspicious behavior. And I being an auditor and a digital forensics investigator in cyber for so many years, 30 years of investigative experience and risk management experience for 120, $150 billion companies, and reporting to boards of directors and CEOs and things. Putting on my risk management hat, I'm looking at that going, everybody's a failure for not preventing this from happening. Because if you state that you want a circuit breaker, whoever designed that immediately needs to be fired from a risk man. And if you had positions on the market and those didn't get triggered and you got washed out and you lost your money as one of the smaller traders, I can imagine the amount of lawsuits that are going to get introduced for sure. And Benjamin asked, could that be illegal insider trading? It kind of is, when you talk about somebody who's a market maker having access to data. The other thing I want to point out, within the whole complex of commodities, the supply chain from the miners to the final product, there are a lot of participating banks and financial entities which sell research reports. So banks and other financial entities with interest in the market collect data. Okay. And they have experts on staff. They pay billions upon billions of dollars collectively across the industry. To say that they could not and even would not have the information and have the capability and maybe even the will to affect these types of trades, that because all the losses affect somebody on the other side of those shorts had to be a long, that maybe it's a legitimate producer or more than likely a merchant, because they're going to want upside protection on the price. A lot of merchants may have got the Apples and Samsungs of the world, if they're participating, they might be in trouble in terms of losing a ton of money. And I don't know. I mean, if if JP Morgan got fined for spoofing and other activities, 920 million, the silver in the treasury market, back a few years ago, after an investigation by the CFTC, because I interviewed the guy that at Silver Symposium a few years ago who was in charge of that department of analyzing all of the futures trade, not just gold and silver, but all of it, who worked at the CFTC. He was head of that department. And he would have been the guy of record because he left a year after JP Morgan was fined. So he had to have led that investigation. And I interview him, and I know for a fact that the CFTC didn't have the right amount of teeth to be able to monitor this market. But they do investigations, and they won that one, 920 million. Okay. So if the DOJ investigates this sort of long-term, small, I mean, it's not small, it's worth a lot of money, but, daily sort of manipulation, that there would not be an investigation into what happened on Friday, and that there wouldn't be some sort of regulatory action taken against either, and I would think it would be both, and it's just speculating because I don't know, it's speculation, okay? Stepping out on a twig on a tree, right? Stepping out on the branch, that one of the participating banks had to have had enough information to affect this for whoever wanted it to happen. And again, I'll go back and say, if you look at the bank participation report, the latest one that comes out from the CFTC, to see how the banks are participating in silver specifically, not gold, but in silver, the US banks are long, foreign banks are short. So if somebody had a large short position that needed to be covered, them for their house accounts or their clients, it would be the foreign banks. It doesn't mean that there weren't domestic entities that participated, but that seems to be where you would start the investigation, is the foreign bank position holdings in silver. And in gold, you would have to look at all the bullion banks and all the players, to be honest with you. But the guys that have the biggest shorts are the bullion banks. That's where you start. And that's where you got to start this investigation. In any case, if you just hit silver on your search bar, it's way down there. There's a bunch of them listed. Daniel's looking for it on screen. But if you search for silver, you'll find it. And the US banks are slightly net long. Now they still have shorts. If you look at was at 15,146 to 15,099. So they're just slightly long by what is that? 47 contracts.
Yeah.
And the non-US banks, it's 9,500 to 50,000. So they're short by about 41,000, something like that. So if you're looking at who may need short covering and a 25% collapse in silver in a day, 25% plus, I mean, who holds the biggest amount of shorts? It's banks, it's bullion banks, according to the Office of the Comptroller of the Currency. And if you look at the CFTC COT report, commitment of traders, and it's the foreign banks that hold it. So I would start there if I were doing an investigation. And then I would go to the CFTC and the CME group, and I would start looking at what's going on. And then I would go to the CFTC and the CME group and say, why did the circuit breakers you designed to not work? And if you're reporting that they didn't hit your circuit breakers, but there was by far the largest collapse in price history, then how did they coordinate that not to trip your circuit breakers? If this is the largest collapse in history and your circuit breaker didn't capture it, what the hell is your circuit breaker for? Are you only for a 50%, a 75%? I just don't get it. But in any case, big smash. The good news is we've had some positive movement forward. Now, it did expose one thing. A lot of people are saying that China was starting to control that market because there's a high premium in China. But I think it shows that the COMEX and the London market, specifically the COMEX, has more control. The participants there have more control of the overall world market pricing right now than the Shanghai does. And the Shanghai has ridiculous premiums, obviously, but those premiums aren't forcing the traders out of the COMEX market. If you look at the COT report, the open interest on silver last week actually rose 4,600 contracts. On micro silver, we're now 36,000 contracts on micro silver that the small guys are playing. If you go to gold, there was a drop of 40,000 contracts, but you're still at almost 500,000. So the Shanghai hasn't taken over anything yet. People are playing the price on the COMEX and to a certain extent on the London OTC market more than they are in China. And it goes to show who kind of what market wears the pants. But the interesting thing is, I don't think it was necessarily a bunch of domestic participants. I think it was a lot of foreign participants. And then you have to say, okay, now you look at the physical side of the trade. You've got the refineries glutted up trying to make 3.9 and 4.9s pure gold and silver. And the refining capacity of the U.S. is not enough for the demand, which means we're at an all-time high in demand in the U.S. because it's the only way that you would lock up the refiners and start refusing business, which has been reported for almost a month. So somebody's buying all that crap. And it's not going on the COMEX. The inventories haven't risen on the COMEX. They've fallen a bit. They haven't collapsed, but they haven't risen. Okay. So where the hell is all of that going? Nobody's loaded it out yet. Yeah, some of it's come off of the liquid side of COMEX, but nobody's loaded all that out yet. So where's all the gold and silver going? To me, I think it's going to foreign banks and their clients. And I think that there's probably a little bit of a raid on gold and silver going right now in the U.S. And, you know, that's why that's what's happening. Anyway, that's kind of I've been going 30 minutes. Sorry, guys. That was probably the longest answer in the history of your channel.
It's good. It's good. People are loving it. Yeah, that was a lot. That makes a lot of sense. You know, Keith Weiner said something similar. I mean, we didn't know, we didn't have time. Like when we interviewed him, it was just happening, the crash, and you know, he said that it was likely contracts, margin calls, and just I was like, it was probably a cascading effect where you, like James Rickard said, that there are algos trading, and the algos are going to try to protect their accounts and whatever the rules are set up. So they see it crashing, the algos start selling. The big banks, you know, will probably it was most likely coordinated. You know, Keith thinks differently, but I mean, look, we're in politics. We lobby. There is corruption in every aspect of society, especially in business. So I wouldn't be surprised that there might have been some coordination because, you know, J.P. Morgan Chase got fined and other bullion banks have been fined for suppressing and coordination in the past. So I think it's extremely interesting, the times that we're living in, the price of gold and silver. I mean, gold and silver's kind of rebounded since it got down to 73. We're at, let me pull this up. We're at 49.3860 for gold and 84.28. We're a little bit down since the open of the markets about 30 minutes ago. But I mean, let me tell you, it was insane. I mean, it was the largest, you're right. It was the largest drop in dollar terms for gold and silver, specifically silver, in the history of the markets. And percentage-wise, it's the second most. It was a bigger drop than in 2011, but it was not the 80% drop that we saw in 1980. I think it was 1980. But yeah, it was, and it completely wreaked havoc in the physical markets, the coin dealers and the bullion stores. I mean, we had to stop selling for a minute to figure out what was going on. The price was dropping so fast. We pulled products off our shelves because we were buying silver in the hundreds, and all of a sudden it's in the 70s, and we couldn't sell a lot of that product. So on Saturday, we just put really high premiums on everything just to make up for the losses. And we sold on Saturday at our store. It was the number one day for sales ever in our store's history. We've only been open for a month, but that tells you something. People were trying to buy in the dip, even with the high premiums. So it's interesting what's going on in the physical markets as well. And what ultimately does that mean for gold and silver in the sound money movement? You know, there's a lot of legislation in the country. There's at least 26 states that we identify that have sound money legislation. In fact, somebody was mentioning that Nebraska is looking to add a sales tax. So it's too late for us to testify. I think it was DD Prepper. DD Prepper. We can't testify. We usually need 24, 48 hours before we can testify. But if there's something we can do on the website, Benjamin Schaefer, our director of operations, he's going to be reaching out to you. Send us an email to support. Let me put that up. So if you guys have legislation in your state that's trying to either pass add sales tax or put other restrictions, let us know. I mean, we're a small team. We're doing our best. We've lobbied in Utah already, Maryland, Florida. There's a lot of states pushing legislation, and with what's going on today with the markets, I mean, it's in the news. Gold and silver is in the news every single day, and it's going to make our job easier to push, getting rid of sales tax, pushing legal tender status. We're really excited about Maryland. It might be the first blue state. We just got it through committee. But, I think it's interesting that we had this crash. There's people are saying, wait, I thought gold and silver was money, Rob. Why is gold and silver fluctuating this way? Well, because it's being manipulated. Gold and silver is being manipulated and suppressed, so especially silver. When you have 105 or 109 to 1 ratio, that's suppression of gold and silver. And then, the hammer, we call him Mr. Hammy, hasn't been successful in keeping it down. Before, they'd smack it down and stay down for months. Now it's only a few days and we're recovering. So, no, Rob, I think you're on something. I mean, you dig into the reports, but ultimately, with what you've done with us at Citizens for Sound Money and what you know about the markets, how do you think it's going to correlate between the prices skyrocketing, the huge fluctuations? What do you think the impact will be?
Well, I'll answer that in just a second. I wanted to go back to the guy I quoted on Morningstar, Luigi DeBellis, and then Keith Winter. I think you mentioned they are correct in that, and Jim's Rickards was correct in that this did trigger short selling. I'm just curious about trigger the algos and short selling and limits and things like that set up on the market. Once it started going down, people want to get out, right, and liquidate their positions. It makes sense. But my only question is, how did you do that without tripping a circuit breaker? And how did they not suspend trading in these markets? I think the long-term effect, well, I mean, we have to go back and see. Here's what I think one of the long-term effect. Quite simply, people are going to lose confidence in the U.S. market. This is just goofiness. And, this can't continue to happen. It's one thing having a $920 million fine to JP Morgan and having some other fines to other entities along the way and having admissions of that stuff occurring. It's another to see a day like this and say, okay, do I even want to trade in the market? People may not even care about manipulation. They may not want to touch a market that does that, in which they're not being protected. Their positions are not being protected. These are leveraged positions. People are getting in not thinking they're going to be washed out and be responsible, for the money to support these contracts. It's especially the smaller players. You got to protect them from the bigger guys who are going to have the potential for concentrated power, whether a big financial house or a bullion or a big sovereign client that may be trading on the market through one of these entities. But I think long term, it's interesting. A lot of my friends have started to get interested. My non-financial friends or non-gold silver friends have started to get interested in the gold and silver markets. This did kind of pique their interest a little bit, but people that were interested in physical who hadn't ever gotten in are kind of like, ooh, that investment going down that much in a day. It's kind of like what happened in the stock market crash in the 80s. It's going to take a little while for some people to want to jump into the small guys to jump in the physical side of the market, which is understandable. It's going to create a lot of questions around the world about the US's ability to manage those markets in a way which protects the participants and the integrity of the market. It's going to spur calls for investigations. And overall, I do think the gold and silver price is going to continue to rise. The reason the gold and silver price were rising was on silver, a lot of industrial demand, but the monetary demand and the risk demand because of stuff going on in the world, geopolitically, financially. We're going to have to see if we get a new Fed chair, what happens and what his stance is as to how that affects the dollar. If you looked at one of the factors that, at least in the short term, not necessarily over 30 years, but in the short term affects gold price in particular is the DXY, or the dollar's relative strength to other world currencies. That had been falling. That was bullish for gold. It started to kind of tick up a little bit, the DXY, a little bit of dollar support there. If in the short term, if we start dropping interest rates at the Fed, that may be a bit bearish for gold because it's going to spur investment in the economy. GDP is going to go up. Now, eventually that may create a liquidity boom crash. Liquidity goes up, too much money in the system. What happened in 2008, one of these markets gets too hot and starts crashing. And with all the derivative, you see the derivative impact on the precious metals market. There's derivative impact on every single market out there. I don't care what it is. Housing market, Lehman 2008, anyone, 2009. Auto market, bonds, all of this has derivative infrastructure on top of it. So from a risk perspective, people are going to look at this and go, there's risk there. And how do I want to get involved in these markets? And with that liquidity boom pushing money, is that going to be the last one before we have serious dollar problems? We've all speculated about that since the 2008, 2009. How long does the dollar have left? So you could see short-term some gold and silver bearishness because of the easing, if that's the expectation by the market. But as those long-term problems start to reassert themselves, maybe you have an even bigger boom to the upside for gold and silver from the monetary side. Now, for silver, being that so highly industrialized, I think there's just rampant shortages. So I think you could actually, going forward, I would say this, over the next 5 years, I would expect silver as a percentage to rise much higher than gold because of both, because of the monetary demand, because of stuff that's going on with the fiat currencies and the financial situation, but also that industrial demand for silver, because we have been in almost 5 years of mining shortage, and it's real hard to get new production, out into the market. So I expect silver to continue to be bullish. I said, my last video Friday when I covered this, I put out a video 3 p.m. I think Central Time on Friday, as we were still, wrapping up trading for the day in those markets. I said, I don't think it's going to come back Monday. Some people said China gets involved Monday, it's right back up. And it's had a nice couple of day run to the upside, but we're nowhere near recovered where we were. And I think I said Friday, I think this is going to take a while. There's going to be some overhang of perception of risk. There's going to be overhang in trust. Some people who don't understand it at all would say, why in the hell would I get into precious metals for those reasons? And we have to see what's going to happen with the dollar. So I think there's going to be uncertainty for the next few months. And I don't really know where the price is going to go. Long term, I'm bullish. I'm an uber bull. I have for 16, 17 years now. I have been. Because the fundamental reasons for gold and silver have not changed.
Yeah.
And we know that citizens for sound money. We talk all the time about gold and silver being money.
Yeah.
Article 1, Section 10. But in the short term, look at the uncertainty. We don't know what's going to happen with the dollar. We've actually, if you look at FactSet, I did this Friday, and it may have changed because their earnings report season for Q4. Q4 is where we get in the black, hence Black Friday. Not only for retail, stocks, but for the whole economy is where we get into the black. And they're at 69% of reporting companies. They're only 13% reporting. Okay, so this is like early poll results in an election. Not enough companies reporting that you project what the overall economy is going to do. But with 13% reporting, of those 13%, almost 70% had an upside surprise to earnings reports in Q4. Now, that was focused on the Magnificent Seven and then on some other areas of the economy, which if you took it out, the vast majority, and that was only, of the 493 remaining in the S&P 500, after you took out the Magnificent Seven stocks, 493 only had a gain of 4.1%.
Yeah.
And if you take out certain industries, the rest of them are probably in the black. So still underlying economic problems, but we're still going to have a GDP surprise, I predict, for Q4. So we'll have an upside GDP surprise. We're going to have maybe bullishness because of a new Fed positioning, in the market, a little bit of a dollar bounce. So, and now all this uncertainty about the commodities markets and the metals markets. And the one last question I have is, does this crash in gold and silver have an overhang to the rest of the commodities to where people are going to look at the rest of the commodities and go, I'm not sure if I want to play in the oil market? A lot of questions to be answered. So I think we will have some bullishness in gold and silver, but man, there's no way I would call when that's going to get back to previous levels. It could take us a while.
Yeah. I think it'll get to previous levels quicker than we expect, just because of what's happening with the dollar, right? I mean, if they cut interest rates, it is going to create inflation, and you're sure initially there is an impact on gold and silver, but then it recovers every single time they cut interest rates. Gold and silver goes up because it just means more currency and inflation. And as we know, inflation is just the expansion of the currency supply, and gold and silver is a hedge against that. It's the debasement. When they cut the interest rates, it's more debasement of the currency. So I think that those fundamentals haven't changed. It isn't like the Fed chair is coming in right now to cut interest rates immediately. I think that was part of the scare. I think that was part of for the people who believe in the efficient market theory, that the markets or the free market's so efficient that it projects out the future in today's prices, and that's what they're saying. I'm not a big proponent of efficient market theory. I just think it was just, look, the stock market, commodities, all that. It's really because it's paper, because it's a paper market and it's not an actual physical market. It's a lot more volatile, and the stock market is just the hopes and fears of people's emotions. That's it. That's all the stock market is. Plus, you have the big institutions that are in on top of the retail. The big institutions are using the algos, or they have their own systems. They're very disciplined. So I think that what we're seeing is retail getting scared, and also the combination of and thank you, Gold Miner James, for that gift. I think what we're seeing is a combination of hopes and fears of the retail market, and also it might have been coordination, like you were saying, Rob. I think it's completely possible. I've seen coordination in government. I've seen coordination in companies. I've seen monopolies, right? Conglomerates. They just take control of a product and they increase prices. That's why they have the antitrust laws. It's human nature. It's human nature to try to control and get more power and get richer because of greed, right? So I think that you're onto something with the manipulation. But I think there's also if this guy comes in and he doesn't cut interest rates, and I think that was the fear. I think what he is historic, which is an interesting point on why Trump would appoint him. He's an inflation hawk. He doesn't like lowering interest rates. He wants to fire Powell for not lowering interest rates fast enough, yet he's starting to appoint a guy who is against inflation, that's probably not going to cut interest rates like he wants. It's kind of like a contradictory move by Trump. But yeah, look, ultimately, this is what we know at C4SM. This is what I know. Gold and silver are money. And gold and silver are the best accounting measure of the amount of liquidity there is in the economy, and it just sucks up and it absorbs that liquidity, and that's where people run to for safety. So I love this report. We got a lot of people on. For the last few minutes, I want to open up to questions to the audience to ask us whatever they want. So, guys, if you want to ask your questions, go ahead in the live chat, post your questions, and we'll see if we can answer a few of them. All right. Support sound money movement. I see buyers paying well over 100. Right now, I'm just going to post some comments. And here, I just want to highlight Gold Miner James for gifting us. Thank you so much for that gift. All right, I don't see any questions. Here we go.
Said, I see buyers paying well over 100 for generic silver on WN. I'm not sure what WN is. Yeah, and I've noticed, I went to APMEX, Jam Bullion, SD Bullion. Their premiums on 1 ounce generic or private mint coins and bars is higher by $1 or $2 on average to retail, but they're still selling. And the funny thing is, Daniel, on Saturday I went to 3 different local coin dealers, and one had pulled their stock, or didn't, they didn't have a ton of stock. They might have sold out, honestly. I was the first person in the door, so they might have sold Friday, to be fair to them. There was one guy I went to, Dallas Gold and Silver Exchange in Euless, one of their branches, and he had sold almost all of his bars. He had left some American Eagles and some rounds. People were buying like crazy.
Yeah.
And, I wonder how that affected the overall profits of those coin dealers were they just taking a bath on it? And it depends on when they bought it. Did they buy it on the way up or?
Yeah. So that's what happened with us, right? Like we had a lot of silver from when we opened up the store that we bought pretty cheap. So I kind of focused and pushed that 1 ounce bars, 1 ounce rounds, actually from Kinesis bars. We got
Yeah.
that at a really good price. I shied people away from stuff I knew that we bought over 100. This goes to Gold Miner James. How is physical demand at your shop, Daniel, and Kinesis Rob? Saturday, I mean, it was just selling like crazy. We were selling silver. People were coming in buying $5,000 worth of silver, $10,000 worth of silver, just under like 9,950. People buying gold. I mean, it was the biggest day since we've opened, and we had our grand opening on the 30th. And how have sales been for you in Kinesis since the drop, Rob?
We had a couple of big orders. We have a couple of big wholesalers that will rate us. We had one come in about $250,000. In fact, let me just go to orders and I'll give you some examples. We've had, $33,000, $34,000 orders. We've had a lot of $15,000 to $20,000 to $30,000 orders. We had a $230,000, $40,000 order come through. We've had more interest. Wow. Yeah, as I'm looking at it, we've had more interest in purchasing PMs from different people as I sit here and look at the orders on the system than we've had in several months.
There you go.
And bigger orders. I mean, the average order size is 15 to 20 to 30 with a bunch of big whale orders coming in. Almost all silver, some gold. I mean, we're basically out of gold at this point. We've sold out, but yeah, just higher order quantity, volume. I mean, across the board, tickets are higher. Substantial. I've talked to some people that we know that are even bigger sellers than us, and they say the tickets, the amount of items on the ticket are going up, and the amount of orders are going up. So we're seeing some retail be lured in here. Yeah, I mean, if you're sitting $121 silver, it crashes down to what was it, mid to high 70s.
Yeah,
you're thinking if it can get to 121 once, it can get to 121 twice.
Yeah.
So they're going and buying for the upside, and good on them for doing it. Sadly, we have been buying gold and silver to put new product in the store, and we bought it at much higher prices. So, that happens when you're a dealer. You live with it. We hope prices go up to where, eventually we'll break even on that. But I mean, that's the life of being a dealer and a distribution company like us.
That's exactly what happened with us, right? Whatever we sold, I had to call all my local wholesalers and dealers, and I was able to get another coin shop to come over, and I bought all their silver. I basically replaced what we sold because we thought the silver was going to skyrocket on Sunday, and it didn't. But at least we replaced our silver, and we weren't in dirty fiat, we were in real money. Next question. Are there any new private mints coming online in the U.S.? I think SG 4184 might be our friend David in Naples, but I don't remember. I think there might be a mint opening up in Florida, but I don't know if there's any other mints coming online. That's a very specific question. Do you know of anything?
I don't know of any big ones. I know that we're working with a couple of smaller mints that their business is exploding. So they were just barely surviving since silver and gold came down, since 2021. And even with the recent rise, there wasn't a ton of retail demand for physical product. There's a lot of retail selling, but just within the last month, they're starting to do some more serious business to support, one of them is a refiner as well. So they're starting to do some more serious business. So, to commission a big refinery takes a long time, as you can imagine. There's a lot of environmental concerns, government regulations. Really, I'm seeing from the people I'm dealing with, just personally for my business, I'm seeing these small to mid-size refineries and mints take on the burden. So all of the guys in the Dallas-Fort area that I have accounts with that will refine like scrap or jewelry into 3/9 fine are not accepting any more business. But what I'm saying is the smaller guys that have capacity and have shops to do this are getting the business, and they may not be the ones that you see advertised, but they exist. And once that capacity, basically gets full, I don't know what we're going to do. I don't know if the government will step in. I know there's big investment coming into silver specifically from the U.S. government, and some of that is for refining capacity, some of it's for mining. How quickly that gets permitted and set up, I really don't have a clue. It's going to take a while for
Yeah.
sure. I think the refinery glut will be there as long as at least foreign buyers, want that silver, and as long as the industry, especially silver, as long as they need the silver. Now in the gold, there's a bunch of above ground gold. You get a high enough price, and people may let it go. Silver, I don't see that. I don't. A lot of it gets used up. 72% gets used up in industry. Now some of that comes back in scrap, but well over half of every ounce of silver produced now goes into a landfill eventually, or gets blown up in a missile, or whatever the case may be. So how, most silver mine now doesn't stay above ground in a form like a coin or bar. You can turn it in, or a jewelry, you can turn it into a refiner. So I think in silver, that's going to become harder to replace that silver than it is for gold at any price.
Yeah. It's, everything's still backed up. But I don't know. I think if there were local mints, they do very well. The next question is: pre-33 AU better to own than Eagles or Buffaloes? I will tell you that the most sold gold product is American Eagles. It's probably the most liquid. But I love pre-33 coins, the St. Gaudens, Double Liberties. I love the Indian head $10 pieces. Those are great. Those are good sellers too at my shop. But ultimately, if you're just looking at like liquidity, I would say Eagles. Buffaloes, I don't really see a lot of Buffaloes because I'm guessing people buy them and keep them. But I know Eagles just sell. 10th ounce Eagles, half ounce Eagles, quarter Eagles, full ouncers. So for your answer, Annie, I would go with American Eagles.
Yeah, I agree with that. American Eagles are always going to be most popular. I learned that the hard way. And, I had a shop that when I had my shop, I had American Gold, Silver Eagles, I had Maple Leafs, I had some other government coins, and I had a bunch of private market product. I would sit on that generic private product, even if I tried to sell it for spot, but people would pay me $10 to $12 over on a Silver Eagle, and maybe, I don't know, 30, 40, $50 over whatever the market was back a couple of years ago on Gold Eagles, because it's the American product. So people, much like people marry the currency of the land, the dollar, they're going to marry the coinage of the land as well. And, those other products, there's a robust market for it. But when push comes to shove, people want the American stuff more than anything, the Buffaloes as well. I mean, they just want American products. This is America. Despite the fact that we've had, a lot of people immigrating for many, many years, people are just proud of the American products in the U.S. Mint.
Yeah. WN for your information is whatnot.
Gotcha. Whatnot. Yeah. So I used to sell them whatnot. So that makes sense.
Space Miner, has there been a notable rise in fractional silver, specifically gold as well? Abso-freaking-lutely. I have been selling fractional gold and silver way more than gold ounces, and fractional has been really picking up. And you know what has been selling like crazy, and I haven't been able to keep it in stock? Copper. Copper is sold out everywhere. All the major copper dealers are out.
All-time high in price in copper.
All-time high. Like I just bought 500 ounces of copper because I bought 50, tested it, was gone in a few days. So I got a bunch of copper now. And fractional silver, I bought a bunch. Believe it or not, bought a bunch of 1 gram silver rounds and bars. 25 grammers, 50 grammers. Oh, that's over an ounce. But I just got a bunch of half ouncers too. We have the C4SM 1/5 that's really selling well. So I see fractional and fractional gold. Fractional gold is probably my number one sold gold product now. Quarter ounces, 10th ouncers. 10th ouncers are selling like crazy.
Yeah, that makes a lot of sense to me. In the Kinesis store, we're going to introduce a half ounce gold coin, and we're working on a quarter ounce gold coin, working on bringing back the bars that we've been out of stock on for so long. And we haven't gotten to fractional silver yet, but our mints have the capacity to do it. And so, as silver creeps back up around that $100 mark, I think it does make sense, because if you want a quarter for $25, that fits a lot of people's budgets. A lot of people don't have money to invest in $5,000 ounce of gold or even $100 ounce of silver. And if you can get fractionals, then if these prices stay elevated, in the long term, which we think they will as we go through our financial problems around the world, then it makes sense to start looking at fractional things. One thing that was very interesting was those little gram bars, like the combi bars you can break off. I've even seen necklaces that have chain links that are exactly like 1 gram, and you break up. I mean, those type of products are really getting developed more and more. And it's interesting to see that. And here's another cool thing I've seen on Whatnot quite a bit, and this is starting to make it into stores. And I carried some in my store. These little 0.5 gram and 1 gram little figurines made of silver that are exact 0.5 gram and gram weight.
Yeah.
And they're either animals or figurines. Those are starting to become popular. I don't know, Daniel, have you seen those?
Well, I just bought a bunch of figurines that look like guns, AK-47s,
Yeah.
AR-15s, you know, like handguns, Desert Eagles. They're actually very popular. I'm selling them. I'm just buying fractional. Those are 8 grams. So they're about 8 grams a piece, almost exactly 8 grams, 8.1, 8.3. But yeah, I am finding, look, because silver's becoming unobtainium, and then, you know, gold's already unobtainium for most. So it's this fractional stuff, and, you know, these collectibles are starting to really pick up. Let me see where the next question is. Got a lot of comments. What is this? What are your thoughts on platinum becoming a monetary metal along with gold and silver? They don't produce enough. There's not enough production. It's actually a byproduct of mining silver. So I don't know. There isn't enough platinum. It's more industrial. It's a precious metal, but as far as I know, there's not enough production for it to be a monetary unit.
Yeah, it was interesting. I had some guy come into my store, and I've told this story a bunch of times. I'll do it real quick. Monster box of Canadian maple leafs, unopened. And that was when silver was like 21, 22. And he's like, I'm sick of silver. I'm sick of silver. I want platinum. I could not source enough platinum to exchange because the only person I had at the time was Dylan Gage. Wholesaler at the time was Dylan Gage. None of the other wholesalers. I called some of my other stores who were friendly stores. They're like, I don't have it. And I couldn't get him enough for platinum. And platinum's done well, but man, I hope that guy kept his monster box of maples, because he did a hell of a lot better than what platinum did. Platinum is ultra rare. It's used in industry, and the price is really how much it's used in catalytic conversions, mostly with a secondary effect of use in jewelry, especially things like white gold, but also in platinum jewelry that you'll see. Costco has a great selection of platinum jewelry. Somebody mentioned Monet in the comments. Monet has 24 karat gold and platinum, I believe, last time I looked. So they have platinum jewelry. So platinum is a nice jewelry piece, but most of its demands catalytic conversions, mostly in the auto market and other catalytic, type of, in industry is where platinum and palladium are used. It is more limited than gold and silver in the ground, but it just doesn't really have that monetary component to it to really drive it like you've seen in gold and silver.
Yeah, and I don't really see any other questions, and we're over an hour, Rob. So, I think we're just going to wrap it up. I mean, this every single time you come on, we have a great show. We get a lot of interaction from the audience. So, thank you for everybody that's joined. We had a few people subscribe. Thank you for subscribing. Thank you for giving us gifts, and make sure you join Citizens Sound Money. You can either join here on YouTube. We have multiple levels from silver up to gold at different amounts, or you can go to citizens the number 4 soundmoney.org, soundmoney.org, and join our annual membership. It's $25 for just the Pioneer, and then there's also $100 for the Gold Pioneer. We'll give you a 1/2 ounce of digital silver from Kinesis. So we have a live broadcast every Tuesday at 6 p.m. Usually lasts between 40 minutes to an hour. When we're Rob, we go a little over just because people are always more active and they love asking questions.
And I'm long-winded, so
yeah, you're long-winded.
I gave a 30-minute answer. I mean, come on.
Yeah, we love it though, and the people love it. So we're definitely going to have you on again. We try to have you on twice a month, so we'll definitely schedule you up maybe in a couple weeks.
Okay, sounds good. Thanks, guys. Appreciate being on.
Thank you, guys. All right, have a good one, guys. See you next Tuesday, and this Friday we will have a premiere, and we will let you know on X. Follow us on X number 4 Sound Money to see who we're going to premiere on Friday.